Investing jargon sucks. We hate it. It's one of the main reasons we started Equity Mates. We really struggled to understand what was going on a lot of the time. And a lot of the friends that we have that we spoke to about investing said the same thing. While jargon is used in any industry, on our more cynical days, we also think financial planners and investors try and make finance sound far more complicated than it really is. Yeah. If it was explained as simply finding great companies and owning them for a long period of time, a lot more people would do it themselves or would at least question what their financial planners were doing.
Absolutely, Ren. So, pardon the jargon, this episode, we're going to break it all down just for you. Hopefully, it helps you in this trading competition, but also helps you ask some deeper questions and put a bit of heat under your financial advisor or whoever is managing your super. Obviously. If you're lucky enough to have a financial advisor, then you don't need to win this competition.
Now, obviously, we can't get through every key term here, but if you head to equitymates.com/glossary, we've broken down a bunch for you. We're going to get the glossary up on the screen now to go through some of the key terms that we think you'll need for this trading competition.
So let's start with NYSE and NASDAQ or Nasdaq.
Yeah, so very simply, they're the two major stock exchanges in America. NYSE stands for New York Stock Exchange. Notable because if you win this competition, you will be visiting there. So very important that you understand that acronym. And then Nasdaq is another stock exchange in America that has a lot more technology-focused businesses. Now, to understand what a stock exchange is, it is simply the place where people go to exchange their stock in companies, where they go to buy and sell companies. So think about it back in the day before computers or even before phones. It was a physical building where people would trade their shares in companies. Now, a lot of it's done online or over the phone, but these organizations still are the organizations that regulate the buying and selling of the companies that are listed with them. So between the New York Stock Exchange and the Nasdaq, the US market is the biggest in the world, and all of these companies that you'll be very familiar with, Walmart, Amazon, Facebook, Nike, Disney, are either listed on one or the other of those two.
Yeah, so here's a question. Someone who is investing in the S&P 500, where does that fall between New York Stock Exchange and the Nasdaq, or is there a distinction?
So for that one, there isn't. The S&P 500 is just the 500 biggest companies on either of those two exchanges.
Yeah.
So if it so happens that at one point in time, the 500 biggest are all on the Nasdaq, then it will be those 500. But it generally is a split between the two, and it doesn't matter which exchange they're traded on. For people who are trading on stake, it also doesn't matter which one they're trading on. You can buy and sell them in exactly the same way through stake.
Mm. Nice. Okay, so that's NYSE, New York Stock Exchange, and the Nasdaq. What else do we have, Ren? We've got bull and bear market.
You're a bit of an animal lover, so why don't you tell us this one?
Okay, so a bull and a bear market, broadly speaking, it's discussing the overall mood and direction that the market is going. So bull, we're talking about investors are feeling pumped up, they're feeling energetic and quite positive about the market. And as a result, they're investing into the market, pouring money in, and we see a bull market that is going essentially in an upward trend direction over a period of time. And we have just been in one of the longest bull markets in history in the US since the bottom of the GFC in 2008, 2009. The market has been in an absolute bull market, tearing up and up and up over the sort of the last 10 years. And there's some debate about whether we're reaching the top of that bull market and about to head into a bear market. And that is essentially where investors start to feel a bit more concerned about overall economic conditions, and they start questioning the investments they're in, and sometimes then leads to them drawing out their money, going into cash. And as a result, the direction of the market trends downward over a period of time, and that's what we call a bear market. And so that's pretty much all there is to know, broadly speaking, about bull and bear market, unless you have anything to add, Ren.
No, I think that was a good description. There are some other terms that you might hear in the course of trading. One that you might hear is asset, and you might be confused where that fits in. An asset is a broad term that includes your stocks, or it could also be if you own gold, if you own real estate, if you own bonds, which we'll explain in one sec. They are all different types of assets. They're just, they're things that you can own and that will fluctuate in value over time. A painting is an asset, just like a share is. So it's just a broad term. It's an umbrella term. I mentioned bonds. Now, there are ways that you can buy bonds through ETFs on the platform. Bonds are really ways for companies or governments to raise debt. So if you think about, if you buy a share, you're an investor in the company, you've given that company money to then spend, and you got a portion of the company in return. Another way you can invest in a company is you can basically loan the company money as an investor, and the company will say, we'll pay you some interest and then we'll give you your money back in, X number of years. And if you do that, then you have a company's bond. So you might hear that, and people make a lot of money trading bonds. So that's a good one to understand. It's just a different way of investing in the company. You're investing in the company's debt if you own a bond. And then one last one that is important to understand the market is interest rates. That is, the same way that you earn interest on your money in the bank, companies pay interest on their debt, and banks make money by loaning out money with interest. It's a really important rate that sort of sets the tone for the economy. When interest rates are low, businesses will borrow a lot and then they'll spend a lot, and the economy will, the idea is that it stimulates the economy. When interest rates are high, companies don't want to borrow because it's expensive to borrow, so it might slow down, an overheated economy in a way. The most common ones that you'll hear are stock and ETF. In a nutshell, they are the things that you can buy in the stock market through stake. So you can buy a stock, which is a share of a company, or you can buy an ETF, which is an exchange-traded fund.
We've got index that you are very much likely to come across when you're looking at ETFs and stocks, and you'll hear the Nasdaq index, you'll hear the S&P 500 index. So what are we talking about? What's an index?
So I'm going to try and keep this straightforward. Tell me if I don't.
Okay.
Essentially, an index measures change over time. What it does in an investing context is it will get a basket of stocks. So, for example, we use the S&P 500 commonly, which is the 500 biggest companies in America. So it gets a basket of those 500 stocks, and it baselines them at whenever, and then it measures the change of that basket of stocks over time. And so as those companies get more valuable, the index goes up. And as an investor, you can invest in the index of those companies. So as the 500 companies get more valuable, the index moves up and you make money. And then what ETFs do is they give you a really easy way to invest in that index. Hopefully that's not too confusing, but just think of an index simply as measuring change over time, in investing context, change in price over time, and then have a look at whatever the index is tracking. So it might be tracking gold, it might be tracking oil, it might be tracking a bunch of companies, it might be tracking a particular sector. It might be tracking the food and grocery sector, or it might be tracking the mining sector. The indexes are just a really easy way to measure that change over time.
So stop loss is a type of order that you can do through stake to do with selling your shares. And as we mentioned in our six-week tips, one of the things I mentioned, Ren, was selling out of your stocks that are going down as an option. Obviously don't have to do it, but something that I would personally probably do in a 6-week period is sell stocks that are losing money quickly so that I could put that money into something else. Now, a stop loss is an order to, well, it's a buy or sell once a stock reaches a certain price. So a stop loss is designed to essentially limit your loss on your position. And what you can do is set a price that you want the stock to sell if it starts going down, so that if it goes into free fall, the stop loss will kick in and limit your losses. It's an advanced type of order. Usually when you go to sell a stock, you can just sell it at market price and it'll find a buyer and seller and sell it at that agreed price. But otherwise, you can put in a stop loss to limit your losses. So for example, I buy Amazon at $10. I don't want to lose more than, say, 20% on that. So I'm going to say I want the stock to sell at $8. And then once the stock goes down, if it hits the $8 mark, it will sell at that $8 mark and I will come out with a 20% loss. If it continues to fall and I hadn't had the stop loss in there, then I could have lost even more money on it.
That was good. I think people definitely got it. And if they want to apply a stop loss, they can do that through Stake.
It's in your advanced orders when you go into the sell section.
Bid and an ask price. When you go to buy something on the Stake app or the Stake platform, you'll see it will tell you what the ask price is. Very simply, the ask price is what sellers are asking for. So they have gone to the market and said they're willing to sell their shares for whatever their asking price is. And then the bid price is what buyers are willing to bid for that stock. So they've gone to the market and said, we're willing to pay this for a share. And when a bid and an ask match, that order will be matched and then the shares will be traded. So just think of it as a way of matching buyers and sellers in the market. When you're putting your order in, you can set a price if you want to. You can, if you want to do an advanced order, or you can just buy at whatever the matching of the bid and ask price is. You can just say invest, $1,000 at whatever the price is at that moment, and that's known as the market price.
Now we're going to look at some of the key terms that you'll come across when you're doing some in-depth, well-thought research on companies. And this is probably, there's so many that we can discuss here, Ren, and they're used in many, many different strategies. And I guess it's up to you to decide which ones are important for you. So we're going to go through some of, I guess, the more general ones that you will see when you're, I guess, looking at your information that's in front of you for your stock. So let's kick it off, Ren. What do we got?
Let's do it. So probably the most important one to understand is market cap or market capitalization. Now, this essentially is what the market has decided the company is worth. So when Apple's market cap reached $1 trillion, the market was saying that as a whole company, Apple was worth $1 trillion. Now, the way that you calculate market cap is the number of shares available in the market times by the share price. So very simply, if Equity Mates Investing Podcast has 1,000 shares on the market and each share is trading at $100, then the market cap of Equity Mates is $100,000.
Nice. So does the market cap change?
Changes all the time. Changes every second like the share price. Well, it changes every second the market's open.
Yes, changes when the share price changes. So Amazon and Apple, I think both at some point hit $1 trillion in valuation, but their share prices have suffered a little since then, and so they're no longer worth $1 trillion. They're in the high hundreds of billions, but they're the sort of two market leaders at the moment in terms of market capitalization.
Earnings or earnings per share. Very simply, think of earnings as profit. Think of it as the money the business takes home after it's paid its employees, paid all its business expenses, paid its debt, paid its tax. What's left is its profit, and then that if you divide that by the number of shares on issue, you can get your earnings per share. And so the way that's important as an investor is if you paid $10 for a share and the company made $5 in earnings, then you've done pretty well for yourself, because that's a 50% return on your investment. You paid $10 and your share of the company that you own returned $5. Now, unfortunately, sometimes you don't see that. Sometimes the company keeps that to do whatever it wants next year, but your share of the investment returned 50%. So you'd be pretty happy if you got that.
You would be. You'd be stoked.
Yeah.
Another one, Ren, to keep an eye on and to understand is trading volume. And that is, pretty important thing to understand, especially in a shorter competition like this one, when you're trying to make a decision on a daily basis on whether or not you can buy and sell. So generally speaking, trading volume is the total quantity of shares that have been traded for that particular stock on that day. You can find it on any sort of financial summary for the stock that you're picking. So I've got Tesla up here, and I can see that for the last period that it traded, it had 5.83 million shares traded for the day. And so if you can dig a little bit deeper and understand the supply and demand of that, it can give you a good idea if it was a lot of selling action or a lot of buying action coming in. It can give you an idea of how in demand the stock is. It's a little bit more for the advanced investor, but something to try and keep an eye on. Something else you'll see in terms of volume on your summary is average volume. Tesla has an average daily volume of 7.2 million shares a day. So it actually was trading below its average volume, which can give you an idea of how in demand the stock is as well.
Price to earnings. Now, we've probably touched on this before, but it's essentially what we were saying before about the earnings that you get from a company, the hypothetical company that we paid $10 a share for and it got $5 in earnings. The ratio there is 2. So for, you paid 2 times the company's earning in the share price. And you see this ratio a lot, and it's a really simple way for people to sort of say, is the company cheap or expensive? Generally, in Australia, sort of 15 to 20 is around the average for price to earnings. So if you're paying, $15 a share, you would expect $1 of earnings. Anything more than that might be a little bit expensive. Anything below that, it might be a little bit cheap. But in America, it fluctuates wildly, Amazon for a while had a price to earnings of 200 or plus, and it just kept growing. So it's a simple ratio that you will see a lot and you'll see spoken about a lot, and it generally is just a indicator of how expensive or cheap a company is.
So look, we hope that helps you get started, and there's a number of other key terms out there that can help influence your trading decisions. But if you didn't know, now you can get started. And that should give you an idea of just how much jargon there is out in the investing world. So we really don't want it to discourage you. We were in your position when we first started the podcast, and we've battled our way through. Hopefully we've broken it down well enough for you. If you need help with a term, either Google it or head to equitymates.com/glossary. Hit us up on social media. Ren's our social media guy. He'll answer all questions.
And I think importantly, even if you go to the glossary or you've listened to this episode and you don't understand the terms, investors that understand every single term still make mistakes.
Yeah.
And investors that never bother to learn half of this jargon still manage to crush the market. Investing returns don't correspond to how much jargon you can define. At the end of the day, as we said in our intro, it's just about buying good companies and holding them for a long period of time, or buying companies that are going to go up in price in the short term and buying them. So don't worry about it if you don't get the jargon. Just get in, have a crack, learn what you need to learn, and just block out all the words that you don't understand.